We live in a world characterized by rapid and accelerating change. Economic, social, political, and technological. Changes in all its forms are often unsettling but cannot be ignored. It will create challenges in coming times, but also investment opportunities. Hello friends, hope you all are doing fine. My name is Zar, and I try to explain things in common man sense. Let us see how the future looks like for investment and other aspects, which can influence the common man and traditional institutes of nations. Change is happening against quite a challenging economic backdrop. 2025 will not be a year of rapid GDP growth. U.S. growth is forecast at a modest 2.0%, with the Eurozone lagging some way behind 0.9% and Chinese growth, 4.2%, well below recent historical averages. Inflation could also prove tenacious due to higher fiscal spending and possible tariff hikes. This in turn will give central banks less room to cut interest rates as they seek to balance growth and inflation control. The result may well be uncertain and shifting market expectations, triggering more bouts of volatility than in 2024. Geopolitical fallout, perhaps due to changing trade policy, could add to the uncertainty. In broad positive sense about the investment outlook for 2025, called productivity. Productivity, i.e., what output we can produce with given inputs, appears to have increased only very slowly in recent years, and on some related measures, e.g. real GDP per hour worked, may have fallen. This has had major economic and social costs. As Nobel laureate Paul Krugman famously observed 30 years ago, productivity isn't everything, but in the long run, it is almost everything. Krugman was reflecting the views of many economists when he argued that long-term gains in standards of living were dependent on raising output per worker. 30 years on, as worker numbers fall relative to overall populations, raising output per worker seems even more urgent. The good news is that AI and associated technologies now offer a credible way to do this. We will publish more on the structural issue of productivity and its important implications for capital markets in coming years. What might affect the U.S. economy is its debt, which has increased now up to $37 trillion, as well as bond withdrawals from China and Japan. China removed its part slowly, but still more than $800 billion are there. And Japan is also holding $1,100 billion in American Treasury bonds. Now, new tariffs of the government are accelerating nations to withdraw their money from it slowly, as America is not sparing even friends. Today's announcement of 14 countries includes Japan, Korea as well, and they are and were friends of the USA. It is a clear indication that the dollar will go weak in coming years, but the USA will make sure that local production will be increased and a cheap dollar will affect the export of home products in the world. Productivity gains will take time to accumulate, of course. This will be a process that continues and deepens considerably beyond the necessarily limited time horizon of this 2025 outlook. But market expectations on productivity are already having an impact on several of the 2025 investment themes discussed in this report. Remember, after all, that the value of a financial asset will not just reflect the present, it also imperfectly anticipates the future. For the global economy, we think 2025 will be a case of staying the course in turbulent times. The ability of individual economies to weather possible geopolitical and policy challenges next year will be determined by a number of factors. But as the growth numbers highlighted above show, there is already a distinction between a high technology, higher productivity U.S. economy and a European economy that is lagging behind on the interlinked issues of productivity and investment. On politics and policy, we think that the future is fiscal. Even though inflation is not fully tamed, the focus of policy is already moving from monetary to fiscal as economies seek to find and drive new forms of development and growth. Expect further initiatives here, notably from China. If you like my content, kindly subscribe and hit the like button. It will help me to dig deep into today's world challenges for nations and the common man. Let us include stocks. For those investors who have the ability to take risks, these will be an effective way to be invested in growth, and we see them as the key to portfolio success. As we discuss, there will be several reasons why, for stocks, the U.S. will remain the center of gravity. These include expectations around rising profits, deregulation, and tax relief. Elsewhere, the outlook for equities may be less vivid, but is still generally bright. The outlook also explains why positives are still apparent for some European stocks, despite relative domestic economic weakness. And the same is true for other regions. The market focus on stocks should not preclude interest in other asset classes in 2025 only. Corporate bonds in the US, Asia, and Europe, for example, are likely to remain interesting for investors for several reasons. These include institutional demand, still high yields, and the return of the term premium. Supply and demand will remain fundamental to commodities such as oil and industrial metals, but we also see other factors maintaining a relatively high price for gold in 2025. In alternative assets, we focus in this outlook on infrastructure, central to investing in future growth, and what we call the public and private mixology of investing in this area. FX considerations will, as always, be a central consideration for investors, and here 2025 and further will clearly be a case of strong economy, strong currency for the US dollar. If the political situation remains stable, the euro will look good in comparison, but rate rises in growth could support the Japanese yen in Chinese RMB. 2025 will not always be an easy year for investors as markets navigate through geopolitical or other risks, including the 3 R's of recession, rates, and rotations. But we believe that these risks are manageable, with markets already anticipating the impact of future economic growth and development. This means that being and staying invested will be essential for portfolio success, both in the short and long term. I hope you find the analysis in this annual outlook useful. U.S. Soft landing, robust growth, strong investment despite USA politics. Europe, modest economic recovery and potential productivity growth through investment. Asia, global growth driver, not just China. Politics and policy, the future is fiscal. Shift from the dominance of monetary policy to fiscal policy. US and Japan with concrete plans for substantial investment. Europe and China still on the sidelines. Acute need to catch up. Treasuries and bonds are expected to remain relatively stable. Investment-grade securities are likely to benefit from persistently high interest rates. The investment risk does not appear to be adequately reflected in high-yield bonds. Interest rate differential and solid economic growth support the greenback. JPY could appreciate further in 2025, also against the USD, EUR and CNY under pressure due to possible US punitive tariffs. Focus on growth stocks within a broad-based portfolio. Solid profit growth for companies worldwide. Persistently high volatility due to a range of uncertainties. U.S. equities benefiting from the special economic policy situation in the U.S. Rising corporate profits and large-scale share buybacks as drivers. Focus still on financials, IT, consumer discretionary and communication services, commodities dash. Supply and demand on the oil market balanced, little price potential. Gold likely to remain in demand as a hedging instrument in 2025 and beyond. Copper on the upturn in the long term thanks to the energy transition and digitalization. Infrastructure, public and private mixology. Infrastructure, new foundations for the future, data centers and logistics, commercial real estate for the transition. Private equity, interesting sector weightings outside the stock market. Risk, recessions, rates, and rotations. Investors must be prepared for a range of trade and geopolitical risks. Fundamentally positive growth expectations should be kept in sight. A broad-based portfolio and active risk management are advisable. The world is going in the direction where countries are becoming habitual to debt. Before 30 or 25 years ago, debt against GDP ratio was relevant, but today even 100% GDP as debt is not considered. Thank you for watching. Hope to see you again on the next topic: economy, history, or hypocrisy, and travel, cultural diversifications. Your subscription is appreciated much to motivate me for further explaining the world and exploring more about the world and its past. Have a great time.